Good morning, good afternoon, whichever part of the world you are in. Welcome to this webinar on de-risking finance for agricultural value chain with agricultural finance. We will begin the webinar very shortly, so please stay connected. Well, hello everyone. So just a quick introduction. My name is Abdulkader Ben Brahim, and I am the Financial Sector Advisor for the Making Finance Work for Africa Partnership. I hope you and your families are all safe and healthy during these uncertain and unprecedented times. This is really our first webinar since the start of the pandemic, and the title couldn't be more fitting. Agriculture and food becomes very, very important at these times of crisis, where we're seeing drastic measures being taken, closure of borders, causing severe disruptions in the value chain, and making it very difficult to ensure food supply for the people. And this is why insurance really can be an effective way to manage risks. And that could otherwise, result in many large losses for low-income people that cannot really cope. But there are ways of doing agri-insurance correctly and effective, and this is what we'll be talking about in this webinar. Before I begin, I would like to first talk about a few housekeeping items. So to keep the quality of the webinar high, we will by default mute all the microphones during the entire session. Therefore, we'd like to ask you to please send in your questions through the chat box feature or the Q&A on the right-hand side of which you can usually see on the right-hand side of the WebEx session. Feel free to submit your questions anytime during the webinar. In order to submit your questions and in order to make sure that it is seen by the moderator, please select all attendees or all participants from the drop-down menu when you're sending the questions. Of course, we'll be circulating the slides and the recording of the presentations to all attendees and registrants. And finally, please don't forget to fill in the survey that will appear at once the webinar ends. So very quick introduction to Making Finance Work for Africa partnership. So we are a G8. We've started back in 2007 in the G8 initiative, and the idea for Making Finance is really to be a platform for joint action between development partners and African financial sector stakeholders to coordinate knowledge sharing, networking between African financial sector policymakers and regulators and the stakeholders as well, and also to play an advocacy role in the financial sector development. We can move to the next slide, please. So, as I mentioned earlier, we're a multi-donor partnership. And these are the logos of our funding members. We're currently hosted at the African Development Bank in Abidjan, Cote d'Ivoire. And we are supported by about 6 or 7 donors. And maybe a quick word on our strategy. So our vision is really to have an innovative, sustainable, competitive, and diverse African financial systems, providing near universal access by 2030 and offering a full range of products and services for the continent. The way we function is we're focused on 3 pillars: financial inclusion, long-term finance, and financial stability. And with a strong focus as well on, we do a lot of work on insurance. We've, over the past few years, we've been working on a program on developing insurance markets in Africa, with, of course, with the support of GIZ. And one of the important pillars of that program is looking at climate risk solutions and looking at how to support rural livelihoods, farmers, and rural enterprises in improving their working conditions using insurance products. So this is a first webinar that will be focused on this topic. It is my pleasure also to introduce to you our speakers and moderator for today. So this session will be moderated by Robert Fieskley, who joined the GIZ back in 2018 and is currently an advisor with the Global Initiative for Access to Insurance and the Climate Policy Support Project. In addition to advising the German Federal Ministry of Economic Cooperation on direct climate risk insurance and agricultural insurance schemes, Robert also supports the development of climate risk insurance markets and programs in India and Zambia. It's also our pleasure to have with us 2 very well qualified, renowned speakers in this field. I'd like to introduce you to Agribusinesses Mukherjee, who is a qualified actuary from the UK actuarial profession with over 13 years of actuarial experience. He specializes in developing and implementing microinsurance products, particularly agri-insurance and weather and yield index insurance products. Agribusinesses also worked in over 30 countries in Africa, Asia, Europe, and Australasia. Agribusinesses is also managing director and chief actuary of Risk Shield Consultants. And also with us, we're pleased to have Douglas Phineas Dora, who works with GIZ as well and has 10 years of experience in the field of agriculture. Douglas trains smallholder farmers in the proper use of agri inputs and on how to use ICT to promote market linkages for their produce. Douglas also spent 4 years in agri-insurance, where he underwrote all lines of businesses, specializing particularly on weather index insurance in Zambia. So welcome to you all. I think I'll stop there and I'll let my colleague Robert take over the session. So please enjoy.
Yeah, thank you very much, AK. Also from my side, a very warm welcome to everybody. And thank you for joining us today to the Making Finance Work for Africa webinar series, today in cooperation with GIZ. Personally, I think I never had such an outreach directly to people's homes due to the COVID-19 crisis. And as AK already pointed out, this is a global crisis which is also affecting the food and agricultural sector. This is not only limited to smallholders, but the entire agricultural value chain, from farm-related operators to agro-processing and financial services. More than ever, any additional large shocks, like an extreme weather event, for example, would have a huge impact on everybody, especially on the poor and the most vulnerable. However, agriculture has always been a risky business, even without Corona. The farmers of, for example, drought-prone areas sacrifice large shares of their income to reduce risks, for example, not investing in technologies. These risks are also a problem for financial institutions and input suppliers, since they can be faced with widespread defaulting on loans and unpaid bills. Agricultural traders and processors lose when they face a shortage of raw materials, and small businesses suffer when the demand of their services fall. Our today's topic, agricultural insurance, is one part of an integrated risk management to de-risk agricultural chains. Linking index insurance, especially index insurance, with agricultural credit and farm inputs appears to be one approach that has contributed to recent progress in scaling up agricultural insurance. So in today's webinar, my colleagues will give an overview of the different pros and cons of this approach, as well as on lessons learned from different use cases in sub-Saharan Africa. First of all, AgriTosh will focus on integration of agricultural insurance with agricultural finance, whereas Douglas Daura will focus on agribusinesses and how to strengthen and replicate these distribution models. So I would like to give the floor to our first presenter today, AgriTosh. Here you go.
Okay, thank you very much. I hope everyone can hear me clearly as well. Okay, so basically, as Robert mentioned, in this session, I'll be going through basically some of the key issues to consider when we are talking about integrating agriculture insurance with agriculture financing. So as a very quick background to who we are and the kind of things we're doing as Risk Shield. So we've been around for about five years now, and we are a specialist technical service provider and a consultancy firm working on mass market insurance, with the focus being very much on agricultural insurance and different types of index insurance products such as weather index, yield index, and so on. So over these 5 years, a lot of these products have led to farmers being insured, about 3 million farmers in total, approximately. And interestingly and very important to what we're talking about today, numerous value chain stakeholders have also been insured either directly or indirectly. So these value chain stakeholders are banks, microfinance institutions, agribusinesses, farmer organizations, and so on. So we work in a range of different areas, and the key areas being on actuarial expertise and technical support, feasibility studies, capacity building, and operational support as well. So in Africa, moving on to the next slide. In Africa, the focus has been very much on work in Zambia itself. So we are based out of Zambia, and we're operating a lot in southern and eastern Africa. We're starting to work now in West Africa as well, and also quite a few countries in Asia, in South and Southeast Asia as well as other countries. So moving on to the specific topics that we wanted to talk about today, to the next slide. In terms of in terms of the integration with agricultural loans, so essentially different types of agriculture insurance products, such as indemnity-based insurance, where farmers are compensated directly for their loss, as well as index-based insurance, be it linked to weather index or yield index, can be integrated with agricultural loan products. So what that means essentially is these insurance products can be distributed to the farmers, either as a mandatory requirement for farmers who are accessing the loans, or on a bundled basis with the agricultural loans, or in some cases even on a voluntary basis, but still with the linkage being through the loans, or even other types of financial products such as savings and so on, potentially even remittances. So what are some of the pros and cons of this process? From the banks and microfinance institutions' perspective, the main advantages are that certainly certain types of risks are reduced. So for example, the risks associated with, let's say, severe droughts or severe weather conditions or crop losses can be reduced because the insurance coverage is there. So as a result, it can lead to a reduction in the credit risk as well as the fact that the insurance can also enable actually more strategic and targeted loan disbursals for agricultural loans in the first place. So one of the things we have seen is sometimes there's a chronic underinvestment of agriculture or underfinancing of agriculture because of the unknown nature of many of the risks involved. So when agriculture insurance is actually there, it can also enable the financial institutions to enter the sector and also to develop tailor-made specific products for the agriculture sector, be it for crop or livestock or assets. Of course, there are many downsides as well, or challenges for the banks and MFIs. One of them being that the perceived cost of lending might be seen as becoming higher because the insurance premium also needs to be factored in. So in some cases, if it is not understood properly, it can be seen as simply increasing the interest rate at which the loans are being given out, which also becomes a problem. There could even be some regulatory barriers or restrictions in actually adding the cost of insurance onto the loan amount in the first place. Furthermore, sometimes banks or even MFIs might say that, but you know what, farmers are not actually interested in insurance. It's a very new concept. They're not aware of the benefits of insurance and so on. So why should we enforce such a product which farmers don't actually have an appetite for? So those are some of the challenges. From the farmer's perspective, though, there are, again, quite a few advantages. One very important one is that having insurance bundled with loans can actually enable them to access those loans in the first place. So we've seen cases where both for banks as well as MFIs, having agriculture insurance has actually enabled them to introduce a specific crop loan product, for example, or a specific product with a single repayment at the end of the season, which is otherwise a very risky prospect for them to do. So it can improve the farmer's access to these specific bespoke loan services. It can also reduce or potentially complement their collateral requirements. So again, one of the barriers for accessing loans is often the quite difficult collateral requirements that banks or MFIs might have, especially when it comes to small-scale farmers. So having insurance can actually potentially reduce or maybe even complement the collateral requirements that they would need to satisfy. And they can also access insurance for their own livelihood protection as well. So apart from improving the access to finance potentially, it can also enable them to, having insurance would also result in them having that security, especially in the event of major crop losses or major climate or weather disasters. But of course, there are quite a few disadvantages from the farmer's perspective as well. One being that there might be low awareness. So one of the things we have seen over the years is when it comes to credit-linked insurance product, regardless of the type of insurance, but sometimes the awareness among farmers is very low. And often this is to do with the kind of product it is or the way it has been marketed and so on, or even who has actually paid for the product, whether farmers have paid themselves or whether the bank or MFI have paid on their behalf. But so that might lead to a low awareness. The cost of credit might also increase, especially if there's not a reduction in the risk in the risk premium of the interest rates. So the point here is that if there's agriculture insurance and if that results in the bank's lending risk actually reducing, there is an argument that the risk rate should also reduce. The risk component of the interest rate should also reduce. But in practice, that doesn't always happen. Or it doesn't happen sufficiently. So that might actually lead to the cost of credit increasing because the cost of insurance is added into the cost of credit as well. And typically, these kind of products are only covering the loan amount. They may not actually be covering the full cost of production for the farmers or even their expected revenue. So that's also a downside. So having just gone through these pros and cons from both perspectives, what are some of the options, and to give you some real case studies where we have seen these options actually working. So one option generally is that agriculture insurance, or AI for brief, can be linked to loans which are insuring farmers either individually or in most cases for small-scale farmers in Africa, they would be as groups. So there are a few variations of this option. For example, in Rwanda, we saw with a certain bank, KCB, that was the Kenya Commercial Bank, having insurance actually enabled them to have specific crop loan products. Now, the insurance product itself was financed by the bank on behalf of the farmers. So it was pre-financed by the bank and added on top of the loan that the farmers received. The product typically covered events like drought and excessive rainfall. And the rate was, the premium rate was fairly high at about 9%. The reason being that this was an area which was very prone to floods. And to the extent that the bank had actually stopped giving out loans without the security of having insurance. So because the insurance product was available, it was able to give out loans again, but with this insurance product bundled with the loans. Now, we've seen another example in Tanzania where it was from the other perspective that a farmer organization called SACAO actually used weather index insurance as a form of collateral. So they used insurance for up to 70% of the loan amount as a form of collateral to access loans from Barclays ABSA, and where the loan was basically financing the inputs directly. So in this case, the premium was actually paid for not by the bank, but by the farmer organization. And that also enabled them to actually access the loan in the first place. Then a third example coming to Zambia very briefly is we've seen with one of the farmer organizations here, ZNFU, they had used a combination of weather index as well as indemnity insurance products over the years for accessing finance. So various banks would finance farmers and where essentially the premium was pre-financed by the bank again and deducted from the loans that were disbursed to the farmers. So in this case, the premium rate was actually a little bit on the lower side, relatively speaking, about 4 to 5%, and it covered various events, including drought, excessive rainfall, and fire. So moving on to another option, I'll come back to the roles in a later slide. Moving on to another option which can be there as well. So to the next slide, please. Yeah. So agriculture insurance could also be linked to the entire agriculture portfolio of a bank or MFI. So as in the first option, we were looking at specific farmers or maybe groups of farmers. You could also have agriculture insurance where it's essentially applied at the portfolio level or at a meso level. So in this case, the bank or MFI would insure its own portfolio and transfer the risk to insurance and reinsurance companies. So in a way, it's a bit similar to the credit guarantee concept, but there are some differences. So essentially with this kind of arrangement, either the full loan amount might be insured or it might just be a percentage of the loan amount, depending on what the typical non-performing loans are or what is the exposure in terms of NPLs for the bank. So in this arrangement, the policyholder would actually be the financial institution itself, which would pay the premium and would also receive the claims. Typically, farmers would not even be aware that there is an insurance coverage involved, and that also has its pros and cons. But in terms of one of the advantages of this kind of arrangement is because of the nature of the product, maybe it's only covering the most extreme droughts, for example, or the most extreme production loss events. The typical premium levels might be very low, and also because it may not be for 100% of the loan amount, it might be a much lower amount. So this kind of product, there have been a few examples of it, not very many to be honest, but there have been some examples where index insurance products, either based on satellite data in the case of weather index or based on yield measurements as well in the case of yield index, have been used. And this kind of product, we've seen this also applying together with other types of agriculture insurance products as well. So it doesn't have to mean that it's either option 1 or option 2. It can even be that both the options are existing together because they can be complementary in nature. So, of course, for this kind of product, there might need to be some further regulatory approvals which needs to be obtained as well. So moving on to the next, to some of the other options which are outlined in the next slide. So there's quite a few. I mean, a few that we've experienced over the years include having insurance on a standalone basis. So this is more a model where the bank or MFI is essentially acting as an agent on behalf of the insurance company. And this kind of model, of course, it doesn't have to be restricted only to agriculture. It can also be for other types of insurance as well. We've seen this model in Cambodia, for example, where one of the MFIs, AMK, has done it quite successfully over the years. But usually this is not a very viable option to start off with. So the option being where banks or MFIs are essentially acting as agents with commission-based or maybe a revenue-sharing model. Usually this is not very successful when it comes to agricultural insurance because in the early years, the voluntary or standalone demand for agricultural insurance, particularly among small-scale farmers, will be typically quite low. There could also be some other options, such as using it as a form of collateral in order to access loans. We have seen this with some of the farmer associations in Zambia as well, who have used agricultural insurance as a form of collateral to access loans or even farming inputs on credit. We've also seen in agriculture insurance being used as an incentive tool to actually encourage farmers to take up new types of tech. So, for example, it could be insurance being used within an electronic wallet so that farmers have an incentive to use that wallet for accessing inputs. There have been some experience of this emerging now in Bangladesh with Bank Asia. And we've also seen agriculture insurance actually reducing the risks in certain niche sectors, such as livestock loans or crop loans, which actually also makes it possible for MFIs to develop and launch these specific loan or savings products for specific crops and sectors. So those are some of the different options when it comes to the integration with agriculture financing. Now, generally, what are the roles that the banks or MFIs or indeed even other types of potential distribution channels, what roles can they actually be playing in this process? There's quite a few. Firstly, one very key role they would play is in the actual distribution of the insurance products, be it on a mandatory basis or on a voluntary basis. A very important role they would also play is in the premium collection. So either collecting the premium from the farmers or potentially even pre-financing or even subsidizing the premium on behalf of the farmers, especially if it's a product that they are directly benefiting from themselves. They will also play a very important role in terms of advising and negotiating on the product design and also, for example, negotiating on the pricing with the insurance companies. So in that regard, they also play a very important role. Operationally, they play a key role in terms of awareness raising or facilitating the marketing that the insurance company needs to do, the awareness raising that they need to do, enrolling the farmers, administering the products, answering questions about the products, and potentially also in the claims process, for example, in reporting of claims, verification of claims, facilitating the claim payments as well, because typically with these kind of products, when there is a claim payment, the insurance company would pay the claim to the aggregator or distribution channel before that party now reflects those claim payouts to the farmers. And also in terms of providing the data that's required for the underwriting and pricing of these products and the claims assessment as well. And also being the legal policyholder for these products, because typically This is not always the case, but in many cases, they would have to play a role in terms of being the legal policyholder of these insurance products. And finally, to dwell a little bit on, okay, so what are the potential next steps, or what are the things that a bank or MFI or even other types of companies can think about if they are thinking about applying agriculture insurance to their portfolios? There's quite a few things. Firstly, I think it's important to understand, what is the potential demand, what is the potential need for these agricultural loan savings insurance products. So that's obviously a very key thing to understand. So again, when it comes to demand and need, I think both from the livelihood protection perspective, but also from the perspective of accessing finance, accessing inputs, accessing markets for selling the crops, what is the role that agriculture insurance can play in all of these sectors. Then secondly, a very important role that banks and MFIs should also consider is, or an analysis that they should consider is to actually analyze what is their NPL levels or what is their default levels related to agriculture loans, and what's actually driving this. So in some cases, for example, an MFI might see that actually their credit risk is very low because of the operations they have on the ground. But that may not fully reflect the actual, let's say, the cost of the recovery of credit, or it may not reflect the extent of restructured loans in the event of a major crop loss event. So it's important to understand both one's own experience as well as the industry experience of NPLs and credit risk. And this analysis would also enable to understand what is the risk premium that's actually inherent. So is it so in terms of what is actually driving the risk premium? Is it the weather risk, for example, or other production risks? Is it the post-production risks, or are there other more fundamental structural problems? So based on these analysis, let's say steps, the first three steps, the banks can then consider different types of insurance options, be it at the micro level or the meso level, at the institution level, with different insurance companies. And this is also a place where both GIZ, Risk Shield, and others can also play a role to help in this analysis. Then, of course, also in terms of supplying data to insurance companies and service providers in participating in the product development process as well. And then also operationally to participate in the sensitization of loan officers, of staff, of farmers as well, if this is necessary, together with the insurance companies and others. And finally, also important to put into place a monitoring framework to actually understand what is the impact of having agriculture insurance linked to loans. So looking at different key performance indicators which are relevant for the banks and also relevant from the farmer's perspective as well. And so all of these steps can actually lead to potentially piloting or scaling up agriculture insurance together with the existing operations that the banks have. So I think at this stage, that's all I would like to say at this point. So happy to take any questions later on. And I'll hand back to Robert.
Yes, Akatosh, thank you very, very much for your introduction of linking the agricultural finance to financial products of MFIs. I think we directly will continue with our second presenter, Douglas Daura. He works with GIZ in Zambia, and the topic of his presentation will be de-risking finance for agricultural value chains with agricultural insurance, and he will be focusing on agribusinesses. So, Douglas, the floor is yours.
All right, thank you. Good afternoon, everyone. I think we can emphasize it more, looking at what we are going through now, just apart from the COVID. This whole thing of risk is something that has come to to affect mostly, the agricultural sector, for the smallholder farmers, and also for the commercial farmers. So a quick run, I'll give you a brief overview of the GIZ projects in Zambia in line with agricultural insurance. Under the climate risk insurance projects, we've had the issue resilience project, which started in 2018 and ended in 2019 September. At the same time, we also had, we have a current one, which is the German Climate and Technology Initiative, GKTI. We are yet to come up with an English name for that and their abbreviations. It started January 2020. It's taking over from the other activities we had on the issue resilience that ended in 2019. And the third project that we have as GIZ, we've got a private partnership with a cotton ginning company, that's LDC, Louis Dreyfus Company. And this project started in June 2018. It will run for 3 years. Within the project, we've got synergies with other projects, especially with promotion of agricultural finance in Zambia, which is abbreviated by AGFIN. With AGFIN, we are basically looking at support of farmers and SMEs in business and investment training. We also look at product development, capacity building for financial institutions. We can move to the second slide. All right, thank you. On the second slide, I want to look at the role of AI, which is agricultural insurance at the micro level and the meso level. In this slide, I'm looking at the smallholder and also the aggregators that are termed at the macro level, which is meso level, sorry. So on the micro level, we're looking at the smallholder farmers. It's got a dual role in that case, in that it looks at protecting what our smallholder farmers are investing into the farmland. And also at the same time, it helps in promotion. It helps in the change of behavior of smallholder farmers. Once the smallholder farmers' behavior is changed and they get to accept insurance, it makes a lot of sense for them to better invest and also have better access to credit. Because I think from the previous speaker, we heard that for an institution to give you a loan, you need to have security. And for smallholder farmers, you find they don't have the actual collateral that they can offer. They don't have structures, they don't have a building or a car that they can use. But if they have insurance, in that case, the financial institution will be free to give them a loan. At the same time, we're looking at the low risk taking, low input and low return on farming. It's a high risk taking, high input and higher return farming. We know agricultural business is a risky business. So hence, the promotion of agricultural insurance becomes inevitable in this case. Looking at the level of the portfolio cover, in terms of aggregators, we also look at, it also got a dual process there. There's also protect. The firm that is giving out the loans to our smallholder farmers also has to protect the investment. These are big firms that are buying inputs and giving us a loan to smallholder farmers so that they can aggregate the product when it is ready. So they need to protect their investment, hence they take out portfolio cover. At the same time, it also helps the company go into other areas they've never been. We've had instances in Zambia where some companies were scared to go to some areas because they were drought prone or they were flood prone. But because of the addition of weather index insurance, they've actually gone to those areas that never been. So we've seen an extent to go into riskier regions. Thank you. We can move to the other slide. Okay, so there I'd like to give an example of contract farming model, which is a micro level that we are involved as GIZ. This is where we've partnered with LDC, Louis Dreyfus Company, which is trading in cotton. It has a total of 100,000 smallholder farmers. So in this model, what we have is we have an insurance company. The insurance company is providing the cover for the cotton that is grown, and basically they're covering two perils, which is excess rainfall and drought. At the same time, we have an insurance cover that is provided by the insurance company. We've got the farmer who are under LDC. They've been contracted by LDC to grow crops on behalf of LDC. What happens in this model is that instead of giving the farmers credit in form of money, they are given credit in form of inputs. So as they grow the inputs, when the inputs are ready, they are sold back to LDC at a price that they have an agreed price already. In that price, when the cotton is delivered to LDC, it's bought off less the amount that they got in the first place. They will deduct the amount for the loan and also the premium, because in this case, the premium is pre-financed. As we know, our smallholders are handicapped, they can't afford to pay a premium. So these firms pay the premium to the insurance company. So at the end of the day, the contract farm or the contract farmer whose LDC in this case is actually the policyholder. When there's a loss, the loss amount is paid to LDC, and LDC will knock off loss on amounts on the specific loans that are for the smallholder farmers that are contracted by LDC. So what is the role of the aggregator in this case? The role of the aggregator is basically premium pre-financing the enrolled farmers. They also help us in creating awareness for the farmers. And then the value proposition in this model that we have is using insurance as an incentive for loyalty based on contract farming. It also offers protection for both the farmers and the company itself. It has also, we've seen here in Zambia that it has also helped in avoiding side selling, because in the past when the farmers had no insurance, we had more cases of side selling. The farmers would decide to go and sell somewhere else if the yield was bad. But in this case, since they have insurance, they've got no reason to run away from their obligation. They will actually take the cotton to LDC for them to buy. And then premium payments, it's both ways. It's mandatory or voluntary, but in the past, it was basically mandatory, but with the intervention of GIZ, we thought it's easier that it goes on voluntary because we did the training for them and they get to understand how important insurance is. So just an example of contract farming model in LDC, I just want to give you a snapshot of the numbers of farmers that have been insured. 2013-2014 to 2019-2020 season, we've had a total of 73,480 farmers take up insurance. And then for the other year, 2015-2016, we've had a total of 51,827 farmers insured. This gives us, a 75% uptake, which is, I think, good numbers looking at the smallholder farmers that we're working with. It shows that with the interventions that we are doing with our consultants and as GIZ, it's also making sense. They get to understand and take up insurance. Yes, the product seems cheaper when we bring it on board, but it has a high claims ratio. From the time that it's been done, we've seen it move to 227%, until 2018-2019. We're yet to get the new figure for the 2020 once we have the results on. So the project that we have, it's a 3-year project, like I had mentioned earlier with LDC. Thank you. Can move to the other slide, please. Yeah, so on the next slide, I'd like to give the approach, the GIZ approach with the 2 projects, the issue resilience and the current one, the DKTI that has taken over the most of the work that we're doing under issue resilience. There, our goals was basically to have an improvement on access to resilience for the smallholder farmers that we're working with. And we have the 4 pillars that we are looking at for this case. Basically, we have to look at replication and also scaling up of weather index insurance. This has to go beyond contract farming. We have seed companies in Zambia. We also have cooperatives that are also involved in aggregation. So we hope and pray that this also moves to this. We've had an example here in Zambia before where we had a seed company use the index insurance as a marketing tool, and that was Monsanto, and it worked so well because they took a cover for a germination cover where farmers would get seed. Once they planted the seed and it took 21 days without germinating, they were able to go back to the seed company and get another bag of seed. So we saw this product work with seed companies, and we would like to promote more of such incentives. And also the other part we're looking at also is the supply side and the demand side. On the demand side, we're looking at strengthening the smallholders to understand the product so that they're able to take up insurance without the intervention of others. It should be sustainable at the end of the day. On the supply side, we are looking at the insurers. In this case, we're basically helping out in building capacity with the consultants that we engage. We're also looking at livestock insurance. Yes, we've basically paid most attention on weather index insurance on crop, but we're also trying to move a step ahead to also look at livestock because most of our smallholder farmers have invested much more in livestock. It's also a stream of income that is helping them through. The other pillar is also to look at risk reduction to compensate risk transfer. In this case, we're trying to look at, instead of just providing the product of weather index insurance, we also provide, climate risk information that will help the farmers, decide what can they do. They can focus, you give them a forecast of the weather, then they'll determine to say, what crop should I grow, or should I grow now, or should I wait? So it's information that will help them decide what they can do. Thank you. We can move to the other slide. Yeah, so we've continued with some work. So far we've done some capacity building. We've basically worked with insurance companies in presentation of insurance models to potential aggregators. We've done this through consultations, holding seminars on agricultural insurance. So this has also helped our work in building capacity. We're also looking at implementation of training of trainers concepts for aggregators. In this slide, what we're doing is we look at the aggregators and look at the structures. When you look at aggregators, we know, like for example, LDC and alliance machineries, they've got 3 levels. They've got the regional staff who are in the region. So those, we target the training for the regional staff that is done by GIZ and contracted consultants. We also look at the field staff. This could be lead farmers or distributors. Then we also train the 3rd level on the farmers. The idea here is that they've got a total of 100,000 farmers. A consultant and GIZ, we can't manage to train all these. So hence, we took the approach of trainer of trainers. So we train some, and then they also cascade the training to the other farmers or other staff that didn't attend the training. We've also done capacity building of insurance, and at the same time also for reinsurance within Zambia. This has been done through consultations. We engaged ILO last year, where we did a training program on agricultural insurance. It was done in a period of 3 months. It was looking at how to design a product, how to price weather index product with a customer centric. So we had an instance where we took the participants to a field where they collected information on farmers and also able to design that product for the farmers. We can move to the other slide, which is the instruments and tools developed so far. With all the work that we've done, we thought of producing some materials for our smallholder farmers. So for the insurance products, we've basically done the supporting product development targeted to the smallholder farmers. We've done support on innovations, e.g. index-based livestock insurance. We've partnered with an insurance company there to work with some smallholder farmers that are working in a dairy value chain. And then also on the insurance awareness, we've developed and printed some training materials. These are posters, training flip charts. We've done credit size information cards. We've done the flip charts. We've done them in a way of a comic, because sometimes if you put too much text for smallholder farmers that haven't done so much in terms of school, it's easier to have a comic. It explains much more. Like what you can see, you see a farmer there. It shows that it's looking at money, it's looking at feed. So that gives them an idea to say, what is it that I'm looking at? So we thought it would be easier to have a comic. And in this case, what we've basically done is we've done all these training materials in English, and we've translated them in 3 local languages, looking at the regions that we're working in. And that's there's Nyanja here in Zambia, Tonga, and Bemba. So at least everyone has a chance to read through the materials that we've done. We've also done a digital tool with a partner that we work with. It's a toll-free line that is working here in Zambia on MTN. Farmers have got 10 free calls a month, and then after that, they get charged. Also, this tool that we've done on the mobile platform, it has also been translated in 3 local languages. It's interactive. It also has a game to it, which gives a farmer, a choice, gives him a lesson whether to pick up insurance or to decide to do something else with their money. So it's a game that you have to play. At the start of the game, the farmer has a number of animals, and we are saying they harvested, they've sold the crop, they have money now. So as he's heading back home, he probably finds a shop that's selling a new phone. He decides to buy a phone or he decides to buy insurance. He has to make a choice, because if he decides not to get insurance and the weather is bad, you end up losing out if the weather is bad. So it has a gaming to that, so that at least it helps our farmers make a right decision when it comes to agricultural insurance. So this is where I end, and I'd like to say thank you for your attention. Those are our contacts on the project as GIZ staff. Thank you.
Yes, thank you very much, Douglas, and thank you very much, Agribusinesses, once again for your presentations. The next step on the agenda would be the Q&A. Actually, there's been already quite a lot of interest and some questions. I guess we will just jump in also. There has been questions regarding linking agricultural insurance more to financial products. So there's been a question from Mohammed Kaju who asks, like in a country like Ghana, where the interest rate by banks are very high and premium rates for agricultural insurance is also very high compared to other lines of insurance products. What will be the main motivation for the banks to bundle agricultural insurance with their loans? And also a similar question I think I can put together from Adota Akwai. Are there any statistics on the impact of agricultural insurance on the recovery rate on agricultural loans?
Okay. I can respond to those questions. It's Agratosh. Yeah, so I think in terms of the motivation for the banks or financial institutions, there can be many. In the terms of, say, okay, of course, the insurance would, lead to potentially the cost of accessing the loans becoming more expensive because if the insurance premium is passed on to the farmers as well. However, having that insurance product would actually reduce it would reduce a large component of the credit risk that the banks or MFIs have in the first place. So as a result, for example, even the interest rates that they might be using to start off with might actually be lower. And in fact, it can even lead to a situation where even with the cost of insurance, the loan becomes cheaper for the farmers as opposed to if the insurance was not there in the first place. So, for example, if there are, let's say, without any insurance being there, the banks might never want to lend to, or they might be very reluctant about lending directly to the farmers because of the huge credit risk that is there. But if the insurance reduces the credit risk to a large extent, then they might be able to, and typically the bank's interest rates would still be lower than what the microfinance institutions would be charging, for example. So you can have a case where the interest rate for a bank plus insurance is still actually cheaper than what the MFIs might be charging without insurance. Yeah, so I think there's I think both for the banks as well as for the farmers, there can be advantages still in having insurance to enable better access to finance. Yep.
And the second question was also regarding to the agricultural loans. Are there any statistics on the impact of agricultural insurance on the recovery rate on agricultural loans?
Yeah, so I think there has been some there's some study. I think there was a publication potentially through GIZ as well. I think we need to check where there was some evidence of the credit risk reducing. So in particular to do with side selling that Douglas talked about, where as a result of having insurance, the side selling reduces. And also relating to the recovery of crop loans in Malawi, I think from what I recall, where it was seen that with insurance, the recovery rates were higher. So maybe...
Yeah, I think picking up from what Agratosh is saying, I think last year we did more like a monitoring and evaluation on how the distributors for LDC were doing, because distributors are the ones that distribute seed on behalf of LDC, and they also sell, they buy the crop from the farmers on behalf of LDC. We had one instance where one of the shed managers actually confirmed that his loan recovery was almost 90%. So I think, it's evident that embedding insurance in the loans is also helping in terms of recovery. So we are yet to do a study, which I think also Agratosh will be part of, that will be able to give a report on with the work that we're doing with LDC, but from what we got from one of the shed managers in his region, he was able to recover at least 90% of his loan because farmers that got insurance were paid off by the insurance and they were able to pay for their loans that were outstanding. Yeah, thank you.
This is very interesting because also related to the contract farming model, there has been one question from Elise Perrin that in the contract farming model, how's the incentive for loyalty? For example, what she asks is, does the farmer get a discount if he stays loyal?
Yeah, with the work that we've done with LDC, yes, for example, for the distributors, since they like they go in between the farmer and the LDC, the company itself. So depending on how much they recover on a certain percentage, they get an incentive, which is in form of money for the distributors. For the farmers, again, I know when you look at agriculture insurance, there's usually people who say, look, I took up cover for the whole year, I didn't claim. What incentive is there for me to, probably maybe pay less? So this is one thing that we do with LDC, and also in partnership with the Risk Shield, we talk to them and say, look, for the past season, there wasn't so much of losses on the smallholder farmers that are contracted by you. Is it possible that maybe we could reduce on the premium amount? So at that point, you find that we're able to discuss with the firm, and they agree to say, okay, fine, yes, we can reduce the premium. So the next year, you're talking to the farmers, they're saying, instead of paying so much money, this season you'll be paying less by so much. So that becomes more like an incentive for them. And it's also easier for LDC to advance a higher loan amount to the farmer who took up insurance. So this is an incentive as well, because the farmer will decide to do maybe 2 hectares now because of the insurance component.
Yeah, and I mean, also with some of the contract farming models, including LDC, as Douglas mentioned, they've also used insurance in the past as an incentive to reward certain types of farmers. So, for example, farmers who have, delivered a certain amount of cotton to them over, say, 2 or 3 years, would be eligible for even free insurance for some of the types of products or for a certain level of coverage. And similarly, also with the lead farmers would receive either subsidized or pre-financed insurance as well. So I think this is also an area where, a few of the contract farming companies, once they've understood the concept and value of insurance themselves as well, in practice, in the case of agriculture insurance, that they have started using it as a kind of incentive to improve the kind of retention they have with the farmers they work with. Yeah.
Yeah, and also like you said before, that the sheds confirm that people return can demonstrate, for example, that this incentive scheme can work. That's very interesting. Looking at the time, also coming to the next question. There's been quite an interest also on the portfolio covers. For example, there's been 2 quite similar questions regarding portfolio covers from Pranav Prashad and also from Lorena Zapata. So what are the benefits for the farmers who take the agricultural loans if there is an portfolio cover? Is there any way of ensuring a fair settlement to the farmers in case of an adverse weather event?
Yeah. So, okay, to share some thoughts on that. I think it comes down to how the portfolio product is structured and how it is. Essentially, what is the need for having a portfolio cover as well. We've seen in some cases, so with some of the other contract farming companies in Zambia as well, they were in certain, in some years, like, so as you know, in many countries in sub-Saharan Africa have only one rainy season, and most of the farming is rainfall dependent as well. So if the season is perceived as quite a risky season, maybe because of the El Nino predictions and so on, it would become very some of the companies might not even operate in the country in those particular years. So in Zambia, we've seen this a couple of years ago where companies were basically planning to pull out of the market because of the uncertainties around the weather. So in this case, a portfolio cover came into place. I mean, they wanted to have a portfolio level insurance product. And for the farmers now, the benefit of that was that, they were actually able to access the investment, access the inputs that the company was giving on credit. So although they were not directly benefiting from the insurance in the sense that they were not receiving the claim payments at all, but neither were they paying for the insurance premium either directly or indirectly. It was being paid for by the company purely as a way of managing its portfolio risk. So this kind of cases happened not very frequently, but it does happen every now and then. Of course, it's important for it to happen consistently so that it's not a case of companies just taking out insurance for the bad seasons and not for all the years. But it can lead to a benefit in that it improves the farmers' access to financing and inputs. Also, it can actually lead to a situation where, if the companies, let's say a bank, for example, is actually aware that a portfolio product is working well for itself, it would be more, willing to actually extend a similar kind of product, but now applied at the micro level. So sometimes you have, for example, an MFI being reluctant to extend it to the farmers because they don't really believe in the concept themselves. So that could also be an advantage. And there's a few others as well. Yeah.
Thank you very much. Also, looking at the time, I would like to really thank the two of you, Ashutosh Mukherjee and Douglas Daura, for your inputs. I think we saw that today that risk comes in many forms, and looking at agricultural risks, there are a lot of benefits for the financial institutions and the farmers when it comes linking these products. But there are also a lot of things to consider for the financial institutions, agribusinesses, and potential new roles for them. So I guess, like you said, there's a few very crucial points that we have to be aware of, like awareness within the target group, investing in local capacity, like Douglas explained, and also we still have to invest in science-based indices. So thank you very much from my side, also to all the participants and questions. And I would like to hand over to wrap up to AK.
Thank you very much, Robert. I also want to thank Ashutosh and Douglas for speaking to us today. And also I want to thank GIZ for collaborating with us on this webinar. Of course, last but not least, I also want to thank the audience for sticking with us and for your engagement. I know that due to time restrictions, we weren't able to address all your questions. So we would like to let you know that we will try to answer some of these questions. We'll take these questions offline. And of course, we will share it to our speakers, and we'll try to get them answered to you through our newsletter, through our e-blast and our emails. So last, also, I'd like to also remind you to please don't forget to fill the survey before right after this. And finally, I'd like to remind our audience to stay tuned for upcoming webinars this month. Given, of course, in light of the crisis that we're living, we will be organizing 2 webinars next week to explore the impact of COVID-19 crisis on the African financial sector. So we'll be doing a French webinar this Tuesday, April 14th, and that will be followed by an English version on Wednesday, April 15th. So I hope many of you will be able to join us next week. So thank you again. Thank you all for your time, and stay safe and stay healthy. Goodbye.